What's up guys, Ben here and welcome to Motivation to Invest. Now today I've got a very special video for you guys. This has been probably one of the most heavily requested videos I've ever had on this channel. In this video I'm going to deep dive into my investment principles and my investment strategy. Now this video is from a series for the VIP community. So if you want more info on that, you can simply check that out by clicking on the link in the description below. Now the next videos in this series for the VIP community, only those videos, they'll be on my portfolio, my six-figure portfolio, all the stocks I'm investing into, my thought process, my strategy, and the reasons why. With that being said, let's dive in. What's the motivation behind this? Why are we doing all this investing? Well, there's a great quote by Warren Buffett and it says, if you don't find a way to make money while you sleep, you'll work until you die. To me, that's a great motivation to invest, empowers you each and every day. So investing is just a tool to help you guys reach your financial goals, whatever they may be. I personally love the entire process as well. So these are just some tips for you guys. So firstly, define your financial goals and lifestyle goals. What type of lifestyle do you want to live? How much free time do you want? Who do you want to spend that time with? Step 2, define your passion for investing. Do you enjoy investing? Do you enjoy the process? Do you like the ups and downs, the wild rides we see in the market? I know many of you guys do, and it is an exciting experience. So you need to define your level of passion. So really it's about loving the journey, loving the process, and loving the destination, because it's not just about being financially free. That is the end goal, but loving the process throughout. And there's a great quote by Warren Buffett, and he says he tap dances to work, because that's what he enjoys doing. He doesn't need to do that. Warren Buffett, he's a multi-billionaire, yet he still studies companies, he still does his investments each and every day. So you've got to know yourself, know what motivates you, but I find if you love something and you're engaged with something, you'll just get better at it. So this is just a brief background on me. I don't want to talk about me too much. I've got a bachelor's in electrical and electronic engineering, first class. Now, I'm not saying you do need a college education to be successful in the stock market. I personally don't believe you do, and I've learned the majority of my stuff not from universities, colleges. I feel like the whole system doesn't really teach you practical skills for life, but I've still got it there as that was my former career. So I've also got a diploma in business and engineering. So majority, I'm a self-taught investor. I've read over 250 books and counting, 250 investment books from everybody from Warren Buffett, Charlie Munger, Peter Lynch, Howard Marks, all of the great investing legends. I've learned from the best, and I've distilled all that information, all that knowledge I've learned, and all that wisdom I've learned over many years of reading all these books, and I've distilled that down into my investment principles and strategy, which I'm going to reveal in this video. So another point is I've actually created and produced over 250 videos on investing for you guys on YouTube. And as the old saying goes, if you teach, you tend to learn twice. And I'm a firm believer in that. So I've also got experience in the stock market. I built up this six-figure portfolio, $20,000 to over $200,000. So I've also had some failures along the way. And there's a great quote, success creates the seeds of failure and failure creates the seeds of success. So when you do have these failures in the market, because everybody does, even the great investing legends, then you can learn from them. And that experience over time will make you a better investor and improve your quality of life. I've also got experience in running and investing into many small businesses, for example, a barbershop, digital marketing company, property portfolio, and many, many more. I've got quite a wide range of experience. In my previous career, I was an electrical design engineer. I was also working on IT design. I was doing contract project work for Microsoft, so that was quite an interesting career path. Very good career, but I decided to leave that few years back in order to pursue my passion. So this is a great quote by Jeff Bezos. Be rigid on your vision and flexible on the details. So let's say your vision is to be financially free and to reach these certain goals in terms of quality of life. Then the details and the path getting there, let's call that our investing tools. You can be flexible on that. I'm always open to new investing ideas and opportunities. So I believe intelligence is your natural ability and what you learn in school, but wisdom is the real power. Wisdom is what you learn in life, and those are the practical skills. Sorry, Cameron Diaz. Know the power of compound interest. So Albert Einstein said compound interest is the eighth wonder of the world. He who knows it, earns it, and he who doesn't, pays it. So we've got one guy here, Jack, he invested $2,400 every year. And we've got one guy here, Blake, he invested $2,400 every year until the age of 67. At the end, he had $2.5 million and the other guy had $1.4 million. So just shows you the power of compounding. It does compound over time the more you invest into the stock market. And the best time to plant a tree is 10 years ago. But if you didn't plant it 10 years ago, plant it today. There's nothing wrong with that. So understand the stock market, because what's this game we're playing? What is the stock market? How does it all work? Well, the stock market is just a place where stocks of companies, which are parts of companies, are sold and exchanged. So you can buy and sell stocks on the stock market. Of course, we know that. But in terms of how does the stock market operate? So an average correction occurs at least once per year. The average correction, so that will be a drop, lasts 54 days, less than 2 months, and the average drop is minus 14.5%. So don't get scared when the market drops and the market goes down and is volatile, because that's part of the market. Second, less than 20% of all corrections turn into bear markets. So that's 1 in 5. So 80% of these corrections, these small dips, don't turn into bear markets. And that's when I say buy the dip. Now, the stock market has historically risen over time despite many setbacks, from the dot-com bubble to the financial crisis to even World War II, if we go that far back. The stock market has crashed and risen. Another quote by the great Howard Marks: most of the time, the world doesn't end. And if it does end, you'll have bigger problems to worry about. And that is so true with the stock market. So historically, bear markets happen every 3 to 5 years. Now, these can be quite scary. So that's a 33% drop on average for the S&P 500. And in a third, that's minus 40% drop in the S&P 500. So that's what you guys need to be mindful of. You need to be mindful is if you're investing into the stock market, once every 3 to 5 years, you could see the amount in your portfolio drop by minus 30 to minus 40%. And what you have to do during those times is to stay strong, stay calm, and actually even buy more if there's opportunities on the horizon. And that's the difficult thing to do in the stock market. So bear markets become bull markets and bull markets become bear markets. So nothing lasts forever. The market moves in cycles. They call this the boom and bust cycle. So it starts off, we have optimism, goes to enthusiasm, exhilaration, euphoria at the top. Then we have unease, denial, pessimism, panic, capitulation, despair, hope, relief, and optimism. So the market does move in these cycles. However, there was a story by JP Morgan, and it says the greatest danger is actually being out of the stock market, and the 10 best trading days occur within 2 weeks of the 10 worst trading days. So these are my distilled principles of wisdom, which I've learned from all my investing experience and actually reading over 250 investing books and making over 250 YouTube videos on investing. So firstly, be a continuous learning machine. So by being here and watching this video today, you're ticking that box by the great Charlie Munger. Never think you know it all, because that is a really risky situation to be in if you're in the stock market, because the stock market will humble you very, very fast. I've seen many doctors, many mathematicians, many accountants who think they know their numbers, and they're eating that humble pie very fast. So the best investment you can make is in yourself. That is a great quote by Warren Buffett in terms of your education, your skills, your wisdom, your experience. And by being on this video today, turning up for this video, watching this video the entire way through, you're making a great investment in yourself. And for all the VIP members, that is a great investment you guys have made in yourself. And this is a great quote. It really does sum up my entire investing philosophy. So it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Now that is a great quote by Warren Buffett, because he used to just do deep value investing, where he used to look for cigarette butts, he called them, and they had one last puff in them. So these were really undervalued businesses, really downtrodden businesses, and those were the businesses that Buffett used to invest into. But now his strategy has evolved over time, thanks to his business partner Charlie Munger, and that he now invests into more exceptional companies, but he still looks for them at a fair price. This is a great quote by Benjamin Graham, who's called the father of value investing. You should always invest with a margin of safety. So let's say you value a company and you know the value of the company is, say, $100 per share. Then really you don't want to be buying it at $100 per share, because first of all, your calculations could be wrong. Second of all, anything can happen in the market. So you want to be giving yourself a margin of safety. So let's say $80 per share. That could be your price target. And the higher your margin of safety, the lower your risk and the greater your potential return when investing. So identify wonderful businesses with a strong competitive advantage or moat. Now this is a great one by Warren Buffett. So it's looking for these businesses with a strong moat and competitive advantage. Now I could do a whole video on competitive advantages, and maybe in the future, if you guys want that, comment below and I will make a video on that. So in the short term, the stock market is a voting machine, so it's on sentiment, it's on emotions, it's on popularity. In the long term though, it is a weighing machine and it does tend to revert to fundamentals. So if it's a poor business with a lot of hype behind it, yeah, we might see the stock price rise in the short term as everyone rides the hype train. However, in the long term, if the business does not produce the goods and doesn't have strong fundamentals, then it will revert to their mean. So know your circle of competence. There's nothing wrong with not knowing something, and really the key is knowing what you don't know. So know what you do know and know what you don't know. Don't invest into certain companies if you don't understand the industry entirely. An example of this could be complex biotechnical companies. They're very complicated. It's very difficult to see how these companies actually make money. So many investors do choose to ignore those companies. Risk is not volatility. That's a quote by the great Seth Klarman, who's also called the next Warren Buffett. So volatility is measured by beta, and that's how much the stock basically moves up and down. So many academics actually quantify risk as volatility, when really it isn't. Volatility is just how much the stock price moves up and down. Risk is the likelihood of you losing what you've invested into that stock. So just know the difference, because I'm a firm believer, and this is a great quote which I use all the time on this channel. I might even have made this up, I don't know, or I've heard it somewhere, but it's volatility equals opportunity. This has been my mantra. Definitely in the March crash, when there was so much volatility, there was so much panic, and that was a great opportunity for many people who invested, including myself. So distill principles to qualitative and quantitative analysis. So quantitative is the numbers side. Qualitative is the intangibles. These are the things you can't touch. This is the brand. This is the business. This is that feeling you get when you buy a product from a business. That's the qualitative stuff. Now, the reason why you do need both, and you need to use both sides of your brain when investing, is because it's not a one-sided game. And this is why we don't see all mathematicians and accountants multi-billionaires, because that's just the quantitative side, and they're very good at that. I'm not denying that. They are very good at the quantitative side, crunching the numbers, finding out what's on the balance sheet, what's on the income statement, what's on the cash flow statement. All that stuff is extremely important, but you also need this qualitative side. And some people are better at either side. Some people might be more of a numbers person. Some people might be more of a narratives person. They understand the story of the stock. And the key way of bringing these two sides together is to actually do both and then bring them together. So find the narrative of the stock, find the story of the stock, and actually convert that story into tangible numbers. Now, this is another great quote. Chances are, if you like the product, you may like the stock. And that's a great quote by the legendary investor Peter Lynch, who's in this book right here. All my books, by the way, my recommended books, they're in my Amazon store. I'll leave that a link in the description. It's all the books I've read over the years and I've actually found really valuable. I have many requests, so I've made this whole Amazon store for you guys. If you see this product is selling out on all the shops, there's queues for this product or service, then chances are the stock might be pretty good as well. Also, be aware of your own psychological biases. So survivorship bias, recency bias, local bias, confirmation bias. Now, I'll probably do a full video on psychological biases in the future, because I think this is extremely important. If you guys want that, please leave a comment below and I will make a video on that. But basically, survivorship bias, don't confuse a bull market with brains. So if there's a bull market, you're doing really well, you're making loads of money, don't just think that that's because of your own investing skill. Know that there is some luck to play, there is some randomness in the stock market. Diversification is the only free lunch in investing. This is a great quote by Haro Markowitz, a Nobel Prize winner. Now, there is a method of investing called a sniper method, where you can actually just have, say, 1 to 5 companies in your portfolio and you know them really well. You listen to all the earnings, you read all the annual reports, and that is a great way of investing, and that is how many investors have built their fortunes over time. But for most people, I would say diversification is the best way to go. Now, understand Mr. Market. So Mr. Market, so we say it's this bipolar person, this person with psychological problems. One day they wake up very happy, very optimistic, buzzing with exuberance. The next day they're depressed, they're down. And the idea is to make Mr. Market your slave, not your master. So when Mr. Market is really happy, really excited, really optimistic, that is when you should be selling to him. And when he's really down and really depressed and he thinks the world's going to end, that's when you should be buying from him. I'm really blasting through these. I hope you guys are paying attention. It is a lot to take in. If you guys like this video so far, then please give it a big thumbs up. Really do appreciate that. If you're not subscribed, feel free to subscribe to this channel and turn that notification bell on. Be guided by your inner scorecard, not just your outer scorecard. So your outer scorecard is how the world sees you. Your inner scorecard is what guides you, your principles. You see this with all the great investors. So if you look at Warren Buffett, everybody was saying, Warren Buffett, you've lost your touch. You're too old. You don't know what you're doing anymore. He doesn't care because he's guided by his inner scorecard. Now, all this information here, I'm actually going to distill this into a book. And I'm currently in the process of writing an investing book. So you're actually getting an early peek into all these great investing principles. Another quote here by Howard Marks: make decisions using a probability distribution. So what's your best case, worst case, and most likely case when investing into any stock? So understand the role of chance, randomness, and luck. They all play a role in our lives, and especially in investing. This example will explain survivorship bias to you guys. So let's say you walk through a factory full of dynamite with a blowtorch in your hand, big flame, and you're waving it around and you're walking through this factory. And let's say you're very lucky and you get to the other end and you're completely fine. And let's say at the other end there's $100,000. Does that mean it's a great strategy? Yes, it paid off for you, but is it a great strategy? Could you repeatedly keep doing that strategy without getting blown up? And that is what you need to know in the stock market. Number 4, this is on contrarianism. So if you want different results, you can't do the same as everyone else. Great quote by Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. So when everyone else is scared, that's when you're buying. When everyone else is greedy, that's when you should be selling or just sitting back and watching on the sidelines. Now, there's a great quote here by Sir John Templeton. So he was actually investing during World War II when everyone thought the world was going to end, and it probably was, to be honest. But the time of maximum pessimism is the best time to buy, and that's when he was buying. And the time of maximum optimism is the best time to sell. The trick is with contrarianism, you're betting against the consensus, you're betting against the herd, but you also have to be right, because most of the time, statistically, the majority is right. Their consensus is right. So if you're taking a difference of opinion, you need to have a real reason behind that. That could be a perception, that could be an information edge, that could be something qualitative. For example, you saw that this product was selling out in all the stores, and you've checked the company's revenues, and you know that that product makes up a large portion of their revenues. Now, that also could be a great strategy. Also requires second level thinking. So the first level thinking is people's initial reaction to a situation. Second level is sitting back and saying, okay, what's the real situation? How can I take advantage of this? Believe me though, guys, this information will not just improve your quality of life. This information is definitely the key to being a multimillionaire and living a high quality of life, because it's just great wisdom for life in general. So there's some other quotes by Ray Dalio. He's a billionaire, world's largest hedge fund manager. Be radically open-minded to other views. If I'm investing into a heavy position into a stock, and this is what everyone should do really, look at the bear case, look at the bull case, assess both cases. Don't just think you're right. Be confident but also knowledgeable. Really what you should do is sit down with someone who thinks the opposite to you and understand their reasoning and their thoughts. But they've also got to be a credible person, not just someone who's got an opinion and they've got no credibility to back them up. Ray Dalio calls this believability weighted decision making. You also create the holy grail of investing, so that's diversification, 15 to 25 uncorrelated streams of income, and that can give you a low risk, high reward bet. So be aware of recency bias. So recency bias is basically something happened recently and that affects your thoughts on what you think is going to happen again. So we saw this with 9/11. So statistically speaking, when 9/11 happened, most people were actually fearful to get on a plane, when really that was the safest time to fly because everyone was alert. Security was at an all-time high. Statistically, that was the safest time to fly. The most dangerous time to fly was just before 9/11, when no one was thinking about a potential terrorist attack. This is the difference between me and I've noticed many other investors, because you've got value investors, you've got growth investors. I personally like to learn both sides of the story, in addition to technical analysis and momentum investing, and try and combine them together in the best possible way. Let your winners run and cut your losers short. So they usually set stop losses at around minus 10% on their stocks to minus 15%, because after that, mathematically, you have to earn a lot more in order to get back to your principal position. It's quite complicated. I'll explain it on another video. Also, buy when the stock has found support. So technical analysis, the stock's down, it's found a support level, I've done plenty of videos on my buy points. I'll link them in this video. That is this video, guys. I hope you found this enjoyable. There's a lot to take in there, a lot of information. If you did find this valuable, please do comment those thoughts in the description below. For my VIP members, I will be doing a portfolio reveal on the next video, so you guys can stay tuned for that. For the rest of you guys, if you haven't checked out the VIP community yet, feel free. There's a link in the description. Check it out and see if it fits your investing style. Access to my buy and sell signals, portfolio reveal, and our private Discord where we have like-minded people all together with the same investing goals. So feel free to check that out. And if you guys found some value in this video, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And if you're new around here and you still haven't subscribed yet, what are you waiting for, guys? Go ahead and hit that subscribe button and turn on that notification bell. With that being said, I hope you guys have a fantastic day, and I'll see you in my next video. Invest safe.